works. And I think this is a good thing to look at if you are purchasing, properties, is looking at where the competition is maybe a little less heavy. And so one of the areas that where competition is a little less heavy and where we seem to have a bit of a competitive advantage is in this middle tier multifamily market. Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hey, welcome back to the show. I'm your host, Todd Dexheimer, and excited to have you here. So, man, I just got back from a trip in Salt Lake at the Best Ever Conference. That was a pretty good trip. I got to connect with a lot of people that I, have met in the past and haven't seen maybe in quite a few years in some cases. Met new people that potentially will do business with, and just learned a lot of what other people are doing. And I think a lot of these conferences, I think one of the best things to do is just to be networking. So I'm in the hallways the vast majority of the time. I'm not listening to a lot of sessions, but I did go into the conference room and listen to some of the sessions. And I think overall, what people are kind of expecting for 2026 is pretty fair. Most people expect 2026 to be kind of the kickoff, the launching of the next cycle. I'm not sure if that's the case. Maybe it doesn't happen in 2026, but I think we're pretty close. Whether it happens in 2026 or 2027, maybe it's even further delayed, but I doubt it to 2028. But either way, we're in a good spot when we talk about multifamily specifically, but commercial real estate in general, office, retail, industrial, you name it. I think commercial real estate overall is in a pretty good position. Is there some distress that could hit the market? Sure. Do I think it's going to be an overwhelming amount of distress? I doubt it, especially when you're talking like where I'm located, where we do business in the Midwest. Like what's going to all of a sudden cause this massive amount of distress? There just isn't a need for it. There isn't a reason for it. We've had good rent growth. Rent growth has outpaced expense growth over the last several years. Really, besides maybe 2022 and 2023 when inflation was absolutely ripping, rent growth has outpaced. So you might see a little bit more distress in some of those southern markets. I think there's a little bit too much optimism maybe in some of these high supply markets like in Austin, Texas, for instance, where Austin will bounce back, but it might take a little bit longer than what people are expecting. I think a lot of people just expect that Austin's going to bounce back in 2026 and all of a sudden resume 5% rent growth. Could it happen? Sure, but I don't see that. So there's a lot of talk about raising capital. Of course, raising capital is a little more difficult today. Investors have a lot of options, and some investors got burned in 2023, 2024, 2025, with capital calls and so on. And so, I get it, but kind of the overall sentiment from both LPs and GPs, but where I like to hear is what LPs are thinking. And there's a lot of LPs that are saying, yeah, look, I did have some capital calls. I did get burned on a couple deals. I had some money that was lost, but I'm actually doubling down on investing in real estate. And I thought that was really interesting that even though they've got some scars, they are doubling down on investing in real estate, and they're looking for new and seasoned sponsors to be able to invest in, and they think that now is the time to be investing instead of licking their wounds. They said, we're done. I cried a little bit and I got over it, and now I'm ready to go. So I thought that was really interesting to hear that from several LPs that I talked with and that heard on stage as well. So, but still, raising capital is a little more difficult. Stock market's ripping, although I think it's going to implode. Who knows when? But I think it's going to absolutely implode sometime soon. But that doesn't mean people aren't going to be overly optimistic with the stock market until the day that happens. And then Bitcoin, seeing some shakiness, so it's not quite as attractive. But those things kind of combined, and That's why people are a little bit more cautious getting into real estate, which is great. I think that's good to be thoughtful and really process getting into these deals, whether it makes sense for you or not. All right, so let's get to it. I wanted to hit a couple of headlines first, then we'll kind of get into the meat and potatoes of what I want to talk about. So, a couple of things that I thought were interesting. Just some headlines. Invitation Homes, they are net sellers in 2026. So, who is Invitation Homes? They're one of the biggest, I think, the biggest single family home owners in the country. So they own a ton of single family homes. They're a private REIT. I think Blackstone owned, and they own a ton of single family homes, but they are now selling single family homes and reducing their portfolio size in 2026. That's going to be interesting to see if other institutional owners and, quite frankly, just smaller, not smaller, but big size owners that aren't necessarily institutional or private, if they start to sell. What's that going to do to the market as far as bringing new inventory onto the market? Will prices go down? Will it help free the market up a little bit? Right now, we've got this really interesting single family home market where prices are high, interest rates are high, and nobody's buying or selling because, well, the reason why nobody's buying is because there's no sellers, and the reason why there's no sellers is because, I mean, why would you sell when you're locked into a 3% interest rate? So it's just interesting to see what's going on. But if we have more inventory that can hit the market and will that help ease some transactions or kind of free the market up? And what exactly will that do? I don't think, unless there's a flood of houses, unless Invitation Homes just sells everything and all these other REITs and larger investors sell everything in 2026, I don't see this huge flood. We are seeing a little bit of an uptick in foreclosures, but nothing to me to be too concerned about. It's more back to the norm. We had a very, very low amount of foreclosures, COVID and post-COVID. And so we're kind of getting back to the norm, maybe slightly above the norm, but basically back to where we typically are. So, yeah, let's see how this plays out. But we do need the single family home market to kind of free up a little bit. I don't think it would be bad if it softened a little bit. I don't think it would be bad if single family homes stayed either at their same value or even dropped a little bit over the next few years. I think that's good. It allows buyers to catch their breath, and as long as they don't go down too significantly, it doesn't crush potential sellers either. And of course, if you don't need to sell, then you don't worry about it. Couple that with the White House continuing to press forward with stopping investors, institutional investors specifically, but investors from buying single family homes. I think that's going to be interesting. I don't think that's going to have a huge impact on the market, but if they're selling houses and not buying houses, maybe that helps the market again shake out a little bit. Over the weekend, maybe it was Friday, I can't remember when it was. The tariff, the tariffs got struck down by the Supreme Court. So, what's that going to do to the economy? I don't know. Your guess is as good as mine. We haven't seen much impact from tariffs so far. Obviously, if tariffs have been struck down, you're not going to probably see much impact. I don't know. Your guess is as good as mine, but it's a headline that obviously everybody's talking about. I think the tariff war is far from over. I think the Trump administration is going to fight back. They're going to try to find other loophole. Obviously he gave a very scathing review of the Supreme Court's decision. And I think they're going to try to figure out ways they can implement as many tariffs as possible. I do think the Supreme Court shutting it down kind of undermines what has already, been done and negotiated. So now it makes probably the U.S. look less strong and less capable of you know controlling controlling itself and to be able to negotiate with other countries. I think this it makes a lot more difficult in the future, in the present and in the future, to negotiate and threaten, really tariffs or anything on other countries because they just go, well, yeah, but you're going to do this and it's not going to matter anyways. So I do think, whether you like the tariffs or not, I do think this ruling from the Supreme Court does weaken foreign relations in America a bit, and we'll see how that exactly plays out. I'm not saying it's going to do a ton of damage, but I do think it does do some weakening there. Um, Another stat I thought was really interesting is renewal leases are 3.6%. So annual increase of 3.6% if you're going to renew a apartment lease. And that is compared to about 0% rent growth. And so this is a nationwide stat, by the way. So every area is very much different, obviously, but that's interesting. And how long can that sustain itself? I think is the biggest question. In my opinion, is like how long does that sustain itself? That leases. This has been going on, quite frankly, for quite a while. So renewal leases are 3.6%, and rent growth overall is around 0%, which means, by the way, that new lease rent growth is actually negative because you've got to factor in the two. And about 40% of all residents, for 40 to 60%, depending on, of course, a lot of different factors, but 40 to 60% of residents renew each year. So, man, that means rent growth is actually probably negative, like 1.5, maybe 2%. 2% is probably a little high, but 1.5 is actually new rent growth. So interesting to see, and we'll see how long that can sustain, or maybe rent growth can start to go up and maybe renewal leases kind of go down. But you'd expect those to be pretty similar. 3.6%. If renewal leases are increasing 3.6%, you expect rent growth to be at least closer to 3%, but that's not happening. All right. So on to what I wanted to talk about today, which is kind of our strategy and why we're looking at it a little bit differently. So, how are we underwriting? How are we looking at deals in 2026? And so, I've talked a little bit about this in the past, but I want to mention too that one of the things, the strategies we're looking at, where it strategically works, and I think this is a good thing to look at if you are purchasing. Properties, is looking at where the competition is maybe a little less heavy. And so one of the areas that where competition is a little less heavy and where we seem to have a bit of a competitive advantage is in this middle tier multifamily market. And so what I would call a middle tier multifamily market is a market that you don't really have individual investors being able to buy because it's a big purchase price, right? It's still many millions of dollars. So we're talking like 30 units at the very, very small end. Now, we don't really probably like 30 units unless it's really close to one of our other buildings, but 40 units, 50 units, up to maybe as big as 100 units. But again, that's getting a little too big because that starts to attract other larger groups to those deals. But so what we're looking at is these deals that are in kind of that 40 to 80 unit range. We really like that market. Now, are those our favorite deals? Absolutely not. So my favorite deal still is 100 plus units where I can have on-site staff. I can have an on-site leasing person, an on-site maintenance person. Quite frankly, my favorite property is going to be in that 200 unit to 400 unit range where I can have multiple staff there. I can have 2 leasing staff, 3, maybe 4 leasing staff, depending on how big it is. And same thing with the maintenance staff. Those are my favorite properties. But the reason why we're attracted right now to that 40 to call it 80 unit, maybe up to 100 unit property, is that there's less competition. So it's kind of the again, it's too big for the small groups, and it's too small for the big groups. No institutional money's going after it. No really big groups are going after them. They just don't. They're not nimble enough for those deals to make sense. And they're too big for the small groups. They're like, I don't even know how I would handle this, bringing on 60 units. First of all, I can't afford to buy it. Second of all, even if I could, I'm not sure how I would even, run that property. It's bigger than anything I've ever done before. So I think there's opportunity right now in those properties. Now they're more challenging. So when you're underwriting them, you've got to really think about what's going on with those properties and why they're more challenging. So again, it's 40 to 80 units. I can't have a leasing person full time. I can't have a maintenance person full time. I have to have people that can bounce around. So when we brought property management in-house, we became much more nimble. We became much more elastic, and we can now bounce our leasing people from property to property a little bit easier. So we have full-time staff. So we're big. So that's the other thing too, and that's why we have a competitive advantage over somebody else that maybe doesn't have as many assets as us and doesn't have in-house property management, is we already have our own staff, and we're able to bounce from one property to the other. And same thing with our maintenance people. And we don't have to hire third party, which can get really expensive. And also, quite frankly, they never run it the way you want. And I'll talk about third party, I think probably on the next episode, and the differences between third party and in-house property management, the success we've had. But just a real quick, I mean, third party property management, the change from third party to in-house for Endurus, at least, has been significant, and we've made massive improvements over third party property management. So it's been a big win for us. Look, I think the biggest thing is if you're going to look for any kind of property, you still need to make sure the fundamentals are all hitting, right? You still need to make sure that if you're buying a 40 to 80 unit property, that it's in a really well located area of town. And probably even more so, I think everything's a little bit more amplified, right? So because we don't have as much room for forgiveness on these smaller property types, so we have to make sure it's in a very attractive and good area of town. By the way, those properties attract a different tenant base sometimes, and so they might be more attractive. We just bought two townhome portfolios, townhome properties that are 40 units. One's 41 and one's 40 units, so 81 combined, but they're in different parts of town. And that's a competitive advantage because we've got these townhomes that are attractive to people. It doesn't feel like this massive apartment complex that some people are just not attracted to. It feels more small, homey. It doesn't feel like some institutional group bought it. So people like that, and that provides you a competitive advantage over some of these other properties. And I know this by owning duplexes and single family homes, and certain people like different things. And quite frankly, when I was a renter, I never wanted to live in a huge apartment building. It just wasn't something that interested me at all. So there it is. Look, I think that when we look at these deals, again, really well located, we look at the maintenance and repairs a lot more closely. And we look at all those little items. Again, like people are like, well, I thought 100 units and over is the best property to buy. Yeah, sure. If I can get it for the right price, it is. But I have to underwrite each deal separately. And this 80 unit deal or 70 unit deal that I underwrite, is it more attractive or less attractive than the 100 unit? Well, again, it all depends on how I look at this deal. If I'm looking at them saying, well, the expenses are going to be the same and the income's going to be the same, and of course the bigger deal is going to be much better. But if I can figure out I underwrote this deal with higher expenses because I know that's the reality, but we can get better income because of X, Y, Z, or whatever it might be. Then that deal still strikes. Well, and the 100 unit doesn't because, it's just so competitive for it. Well, it makes a lot of sense for me to buy that 70 unit property. So understand your expenses are going to be a little higher. Understand because look, maintenance is higher. Evictions, you have one tenant gone, it does more damage for 40 units than it does for 100 units. It's just the facts, right? So you have to make sure you're underwriting for that as you're looking at these deals. But something to look at, and as a LP investor, something to think about when you're looking at these deals. Also, but by the way, make sure that you can control the controllables. Like I said earlier, like one of the reasons why we're attracted to it is because we have in-house property management right now, and we can really be nimble, and we have a competitive advantage. If you don't have that competitive advantage, you can't be nimble and you can't really control the controllables. You should not be buying those properties. You should stick with the 100 plus units. And by the way, we still like 100 plus units like that. We're looking at those deals. We're looking at 200 unit deals. We're looking at 100 unit deals. We would love to buy those deals if the prices make sense. But right now, for the most part, when we've bought a few over the last couple of years, but for the most part, those deals aren't making as much sense. So that's what we're going after. What else are we looking at in the market? Look, I think you have to look individually. In right now in the U.S., we have such a split market between the South, Southeast, some of the West mountain cities, then the Midwest, the Northeast, and even some of the coastal markets. We're seeing rent growth in the Midwest and Northeast and coastal markets. But by the way, not all of them, though. Not all of them. Some of them have had too much supply, and so they're actually seeing rent declines. But you have to really understand what's going on in your local market today to understand what's happening. But you're still looking at the macroeconomics and what is happening overall in the U.S. I think is really important to come up with your investment thesis and then boil it down and narrow it down to your own individual market. And so for me, when I look at it, I see that there's a high amount of renter demand. I see that there's building supply is going down drastically, which we kind of all know, right? In 2026, 2027, especially, you're going to see a lot less supply hitting the market. And right now, inflation for goods and services looks like it's fairly stable. We'll see what happens, but it looks like it's fairly under control. And so I think to me right now is a great time to be buying because of those things, and interest rates are potentially coming down but stabilized at least. And so I think that really provides us a good opportunity in today's markets. What could derail it? Certainly a recession. I don't see a recession on the horizons, but I don't think I feel like that's when recessions do happen, when a lot of people aren't paying attention to a recession. I shouldn't say I'm not paying attention. I certainly am. But I'm really optimistic about the future and the growth that we're going to continue to see over the next handful of years. And if you can buy right, finance right, I think it's a great time to buy with rent growth and the economy doing well and all that kind of stuff. Um, all right. What else? Look, be smart. I think in today's markets, smart money is going to win. And I think patient money is going to win. That's, cash flow, reserves. There's a lot of talk too, actually, at this best ever conference about C-class properties. And I think you got to be careful when you're going into C-class properties. I understand people talking about it because it is a dynamic that you might be able to get into some C-class properties for some pretty good cap rates and do okay. But you have to realize that C-class on paper looks really, really good. And when you actually start to operate it, it's not as good as what you typically think. And so you have more evictions, you have higher turnover, you have more expenses because the property's older, because it's more damage is done to the property, all that kind of stuff. And so you have to realize that the C-class property may look good on paper, but is it going to actually perform? So something to look out for if you're a C-class operator and you do well with C-class property. I think there's some great opportunity that's coming down probably the pipeline over the next 12 to 24 months. And so I think you can capitalize well on it. But if you're not a C-class operator and you don't want to be one, I think you just kind of let that lie. And try not to get caught up with the shiny object that might be something that's going to, pull you down, because again, C-class is just really hard to operate. And it's a different beast. It really is. It's a different beast. And it to me, C-class fools a lot of people because it looks so attractive on paper, but then when push comes to shove, it's really hard to operate. All right. Well, that's all I got for today. You have a fantastic rest of the day. Make every day a Saturday. Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe. Give us a thumbs up. Go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.